Welcome to the EXP Group's discussion of CIMA paper P1. Today we want to tackle another major area of the syllabus and look at some of the key concepts in connection with forecasting and budgeting techniques. In terms of quantitative methods, the candidate will be expected to know a little bit about the time series techniques to analyze time series, in which we are looking to extract from a series of observations some systematic pattern in the data. Now, there are two main models that we can use, the additive and the multiplicative model. The key thing is that these models both address the issue of identifying whether there is a trend which is evident in the data. Let's think about the sales at a company which generally move up, hopefully from year to year. In other words, the company is growing, so there is a growth trend. However, if we break up the years into finer time periods, which could be quarters or months, we may see that the data actually moves up and down as it grows overall. In other words, there may be a seasonality pattern within the overall trend. So the idea is to be able to apply techniques which can extract and describe this pattern. Let's look at the additive model. The additive model is talking about the observed series as constituting a trend plus a seasonal impact plus a random impact. The random impact is simply part of reality. It's what we call the noise in a set of variables. It's something that doesn't have a systematic element to it. And in the numerical exercises which are done in this, or presented in this paper, the random impact can be essentially ignored because it's not quantifiable, and we'll be focusing on trend and seasonal impact. Now, the difference between the additive and multiplicative models is that the observed time series is merely constructed and described in the first case by adding the seasonal impact to the trend, and in the second case with the multiplicative model is by multiplying the trend by some factor which represents the seasonal impact. Now, in the context of budgeting techniques, the candidate is expected to have a basic familiarity of cost categories. The direct and indirect costs should be straightforward. Direct costs that can be directly attributable to a product, also known in the production costs environment as being prime costs, and indirect costs being everything else that is not directly attributable to a product, also referred to as overhead costs. Other ways in which we can think about costs in terms of category and behavior is the fixed versus variable distinction. That's quite straightforward. And then other types of costs can be mixed costs, which have both a fixed and variable elements to them. And another area of costs would be step costs. These are costs that remain fixed for a certain range of production. Let's say we have a garments manufacturing, and we have fixed costs with regard to supervisors' salaries. And as we increase production, the supervisor's salary stays the same because we have one supervisor for 10 people, 10 direct laborers. If we press the capacity and we hire 2 more people, we still may have one supervisor who's supervising, instead of 10 people, he may be supervising 12 people, and then at that point we say we need to hire a second supervisor and perhaps break up the groups and rebalance the number of workers per supervisor. So if we hire a second supervisor, the costs will go up in a step form. One can also think about the step form as being applicable, say, to the built capacity of a plant. As we make additional capital investments, we are able to support a higher level of production. Step costs have a wide variety of applications, and their behavior should be well acquainted to the candidate. The syllabus also requires more than a passing understanding of budgets in terms of what they're designed to accomplish. Now, a budget, the most practical definition that one can suggest, and there are others, is a quantitative plan addressing the future. So it's planning, and it's putting numbers into one's plan. Of course, we speak of goal congruence, that the sum of all the different budgets at the department and divisional levels should add up to an overall plan for the company that should advance the corporate objectives of the company. At the same time, we know that complicated budgeting processes also have some tremendous drawbacks. For example, they can lead managers to game the system. In other words, to fulfill budget, the manager may make some suboptimal choices. Let's just take one simple example of gaming the system. Let's say that the budget calls for a certain limit on the expenses of a department. It's possible that a manager will withhold making certain investments and incurring higher expenses because he wants to stay within budget, even if he is forfeiting eventual growth in the future. In other words, he wants to keep his results good in the short term, but he's doing that by deferring certain kinds of expenses. Let's say he postpones the training needs of his people. Very, very bad thing to do, because while he's saving money in the short term and therefore looking good in putting the best possible face on his budgetary result, he may be compromising the ability of the company to compete in the future. Budgets are also well known for being inflexible. Once they're set, to change them becomes a rather onerous bureaucratic process. Many employees have a feeling that the budget is imposed from the top and therefore is forced on them. Sometimes it's difficult to discern the connection between a budget which is relating to 1 year of planning with the company's strategy, which may embrace a multi-year set of objectives. Budgets are used for many different purposes. In classroom discussion, these are elaborated extensively. Because of the top-down nature of budgets and being somehow centrally controlled, the centralizing tendency in a company with a very rigid budget process means that there is relatively less delegated decision-making power given to people across the company, and that can lead to some degree of frustration or demotivation. And finally, there's that word again, goal congruence, may be compromised when we compare the objectives of the corporation as a whole, how the different divisions are performing, and the departments, and right down to the individual level. Very important area is to appreciate the drawbacks and the ways in which budgets can actually impede an organization from being able to ably perform. Here's a quick summary of the key budget types of budgets which will appear in the syllabus. Fixed budgets, that's our starting point. Sort of traditionally set it up in January and you operate it through the year. Then there's flexible and flex budgets. Please note the distinction here. It's adjusting the budget to different volumes of output so that we have some basis of relevant comparison when we compare budget against actual figures. A zero-based budget looks at the budget from year to year with a clean piece of paper. It's rather radical in the sense that all expenses have to be justified, and anything that was spent the year before is no basis for, cannot be taken for granted as being authorized for the next year. So here it's a more rigorous process of having all expenses and everything basically that one does within a given business unit has to be justified from the ground up. Activity-based budgets, we talked about activity-based costing before and had already anticipated that the budgeting process using ABC information is a more sophisticated way of running one's budget, but it's a logical next step in terms of introducing ABC techniques to the budgeting process in the company, and ultimately thinking in terms of managing based on identification and streamlining of activities within a company, something we would call activity-based management. The incremental budget sort of comes back to our starting point here with the fixed budget. At the end of the year, when one takes forms the new budget, one takes last year's budget and just makes certain small adjustments to it, maybe a couple of percentage points up or down based on what one expects to happen to revenues, costs, and so on. Incremental budget is simple. It may be appropriate if we are talking about operating the budget in a rather stable environment, something which is not changing drastically from one year to the next. Then an incremental budget can be the appropriate way to manage a budgeting process. Remember, we're always looking for the simplest form or technique that does the job competently. In other words, there's no point in complicating a process if it does not produce additional benefits. That's a prime principle of management. Thank you.